morning, everybody. It's wonderful to be here. I've been trying to make it to this event over the last 2 or 3 years, but somehow or the other it's clashed with some other schedules. So I'm glad to be here finally. I know you had an invigorating session yesterday with some really good speakers talk about the future of this country. My presentation, I'm going to try and look through a few things because there are certain debates out there like what's happening to the bull market in India, how mature is it, how much more do we have to go before this all gives up, why equities is probably the best asset class for you to own, for your investors to own, why you should be advising them to have a larger proportion of their saving in equities. What is liquidity? Because again, if you switch on a TV channel and if you listen to people talk on TV, most people are saying there are no fundamentals here, this is all liquidity. And once the liquidity goes, stock prices are going to come down. So what exactly is liquidity and how reliable is it? Then, the other often heard comment in the markets these days is valuations, which is, stocks are very expensive. They're rich and they will not generate enough returns from here. So again, I'm taking a special look on valuations. And then, my favorite thing on timing versus time. Everybody loves to time the market. Everybody loves to buy at the bottom, sell it at the top. How tenable is that? And exactly what you should be doing about timing. And finally, a small segment on how to pick stocks. This is not comprehensive, it's just one approach. There are multiple approaches out there. It's based on some research that we've done last year on 2,000 listed companies in India, and we've come up with some conclusions regarding how India generates its winners. So, and then we'll conclude with 3 forecasts, and take this all with a pinch of salt because I go wrong very often. My strike ratio is 50%. Which is about the same as a toss of a coin. So if you sit here and toss a coin, you will also get 50% right in the long run. That's what I get right. But, there will be some entertainment as I talk about markets, flows, and earnings. So let's kick off with the first one, which is India's bull market cycle. So this is a logarithmic chart of the Sensex going back to 1979. Now, I keep telling my people in the office that I enjoy an enormous competitive edge over my sell-side compatriots because I've been in the stock market since 1985. So I've spent 32 years and I've got a picture of the Sensex sitting in my head. And, that's an enormous advantage to have because you've been through all these cycles, what caused the market to go up and what caused it to go down. At least in hindsight, we try to figure that out. But it kind of gives you a sense. Now, if you look at this chart, and if you didn't own equities when you were born, you're really stupid. Because just look at this. Okay? I mean, even the correction that happened in 2008, the correction that happened in 2001, the correction that happened in 1992, the correction that happened over the last 3 months, I mean, these are so insignificant in the context of what the market has done over such a long time frame. Yet, we've divided this into 7 cycles. We are in the 7th cycle and the 4th bull market of India's history since 1979. So, approximately 40 years of history and the 4th bull market. This is by far the longest one. It started in March 2009 in the aftermath of the global financial crisis, and it's already 8 years old, 8 and change. However, it's the slowest one, which is if you measure it in returns produced per week, per month, per day, it is actually significantly slower than any other bull market. The fastest one was the Harshad Mehta bull market, as it's famously called. I don't know how many of you were there at that time, but in 1991 May, the BSE Sensex was at around 900. By March 1992, which is in about 9 months, it was at 4,500. The Sensex was a 5-bagger in 9 months. So, compared to that, this seems like a very feeble bull market, but it is being the longest one. I think just the pace of rise suggests to me that it's been a very hesitant one. It's not typical of previous bull markets, which cause stock prices to go up vertically and then explode, like we saw in 1992, then we again saw briefly in 1999. We saw that in 07, the Sensex was up 50% in a single year. We've not come to that stage. So I think just based on how prices have behaved, I think there's a long time to go before this thing blows up. My own view is another 5 years, and I think the Sensex could nearly triple in those 5 years, and then it will start looking toppish. So you have a way to go. If you have the patience, and you need patience to make money in equity, just stay put. Don't try to trade this thing. Because you just imagine what you will miss if you try to pick up every 10% correction. And there will be a few of them along the way. In fact, between 2004 and 2008, the index had two major corrections which were exceeding 25%. Imagine if the Nifty were to correct 25% today, that's 2,500 points gone. So I don't know how many in this room will still be in equities. But if you had stayed in equities in 04 and then again in 06, there was a lot more money to be made. So there will be corrections along the way, but I think we are safely entrenched in this bull market, and there may be some time to go before it's done. This is the reason why equities generate premium returns. So this is a very simple chart. It's the drawdown of the Sensex, which is how much does the Sensex fall from every successive top. So you see in 2008 it fell 60%. Now what is this? Essentially it is the amount of time that you spend in losses. I'll give you a number. If you were invested in stocks from 1979 to today, 94% of the time, yes, 94% of the time you were running losses. 57% of the time your losses exceeded 10%. And 33% of the time, that is 1 in 3 days, your losses exceeded 20% in the Sensex alone, okay, not in individual stocks. Now that requires tremendous stomach, because imagine if every third day you are going to be 20% down, it takes a lot of courage to hold on. So just by Darwin's principle of natural selection, a lot of people fall by the wayside because very few people have the stomach to withstand such losses. And therefore, the residual portion of the population that holds on to equities end up making a lot of returns. This is why equities generate premium. This is why you need tremendous patience, a lot of character, a lot of courage, a lot of stomach to withstand equities. Even if you are investing for the long run, because of the number of drawdowns that you face. In fact, recently the market was down 5%, and everybody was like, this is the end of the bull market. Every 5% correction tests your character. And when you pass that, you get superior returns. This is why equities are such a good asset class. Mind you, you don't get this in fixed income. If you put money into a bank fixed deposit, every single day, the value of that fixed deposit is higher than the previous day. Unless, of course, the bank blows up, which is very rare. And at least in India, that does not happen. And if you're a small investor, then you're anyway protected by government insurance, so you won't blow up. Compared to that, equities, are certainly far from a straight line. And that's why equities generate premium returns. Remember this. When stocks correct the next time, remember that it takes that character to hold on to it, which is what will help you make superior returns. Now the question on liquidity. So this question keeps coming up. So most people conflate liquidity with flow. That there's a lot of domestic liquidity in the market. Why? Because domestic households are buying stocks. But people forget that for every stock that's purchased in the market, there is a seller. So the net flow in stock market is always zero. So liquidity defined by flows is completely faulty. Flows don't define liquidity. Even in the last few months that for domestic investors have been buying stocks, that buying has been matched by selling by some category of shareholders or the other. More recently it's been foreign investors. On other occasions it's somebody else. Sometimes it's domestic investors themselves selling to each other. But the point is that there is zero net buying in stocks. Zero. Never on a single day will there be anything other than zero, because that's how a transaction gets placed in the market. So what exactly is liquidity? I define liquidity as the force of the bid or the offer. So that is liquidity, which is how powerful is the bid, how forceful is the bid, and how forceful is the offer. When liquidity is rising, the force is on the side of the bid. When liquidity is falling, the force is on the side of the offer. Like in 2008, liquidity was turning negative because there was more force on the offer than on the bid. Right now, there is more force on the bid than the offer, and therefore liquidity is rising. We've really not figured out how to predict this. What I can do is measure it. And we've come up with various models to measure it. This is one such model. I have 3 other models, but this is one very simple model, which is the gap between the market's multiple and the market's earnings growth. If that gap is rising, it essentially means that liquidity is rising. If that gap is falling, as you can see, it fell very sharply in 2008, liquidity is falling. Right now, the gap is not actually at high levels. It's somewhere in the middle of the range. And therefore, I would say liquidity is still building up in this market. We have not hit a peak. The usefulness of this measurement is that when that gap rises far too high, then you know that you're dealing with exuberant market. You're dealing with overcharged market, and therefore you have to be careful. We have not reached that stage as yet. I think liquidity is still pretty middling, and is probably going to rise rather than fall. But this is some insight on liquidity. This is about the how to look at valuation. So I have 3 slides here. So the first thing is that people comment on India's P/E ratio as being too high. The market trades at 18 times forward earnings, and that's too high. See, the problem with that statement is that earnings is a very cyclical variable. This is the purpose of this chart, to show you how earnings actually behave. They go up and down all the time. Now, the problem with the P/E ratio metric is that if earnings are high, P's will appear low. Does that make the markets cheap? Probably not, because the next thing is that earnings are going to fall. When earnings are low, like they have been for most of the last 3 or 4 years, P multiples are high. Does that make the market expensive? Probably not, because earnings are going to rise. And the market is a forward-looking animal, so it's not going to hand it over to you on the platter by trading cheap on low earnings. It will likely trade expensive on low earnings and cheap on high earnings. So P is a very bad metric to judge valuation. So that's the first message that I wanted to leave behind. The second is that the better way of looking at this is price to book. See, book is a very stable measure. Now, of course, there are accounting issues with all this, and you have to understand that when we measure financial performance of companies, we're dealing with the limitations of accounts. The best way to do this is always to measure cash flows, and even better is to basically discount future dividends, and that's how you arrive at the fair value of a stock. But those are complicated methodologies. They're not easy to put in practice, and therefore a very easy thumb rule is use the price to book multiple. Now, when you look at price to book, it's very different from P. Where are we? We're right in the middle of the historical range. There's really nothing in this either to say that valuations are too cheap or too rich. In 2002, you could stand aside and just buy the market because price to book was 1.7 or 1.8. Forget about everything else. India's macro was bad, earnings were bad, growth was not very good, there was recession in the world, but stocks were cheap. Same thing happened at the end of 2008. The opposite happened in 2007, the opposite happened in 1999. Right now, I can't say any of this. Neither are stocks too cheap for me to shut down everything else and just buy stocks blindly, nor are they too expensive for me to say, it's good that the economy is doing well, earnings are doing well, but stocks are too rich. They're right in the middle. Actually, valuations have usefulness only at extremes. They are very, very irrelevant when they are in the middle of the range for calling stocks. When they get to extremes, either too low or too high, you can ignore everything else and just focus on it. We're not there right now. We're right in the middle of the range. India is actually looking pretty okay on valuations. If you look at the price to book multiple and go back to my first chart, which was on bull market cycles, India's range has been 2 and 5.5, which is, it goes to a low of 2, it hits a high of 5.5. We are right now at 3. So we're now neither at 2, we're not at 5.5. When this market starts inching towards 5 times book, that's the time when you want to sell stocks and run away. We're not there yet, as yet. And the other thing about valuations, and the last point on valuations is that it's always relative. there has to be a context. Equities don't trade in vacuum. They trade relative to other markets. They trade relative to interest rates. If interest rates are rising, it means you're going to offer lower P ratios on stocks. Look at this chart. This is India's PE relative to the US. And if you look at this, you won't feel that equities are actually expensive. It just hit near all-time low a few months ago, and it's just rising from there. So when you look at valuations, don't look at them in an absolute context. Always look at them on a relative basis, relative to interest rates. In fact, I'll make a separate point here. The 10-year bond, which is usually the benchmark used to compare the equities, is at 6.5% right now, which means that bonds are trading at about 16 times earnings, the inverse of 6.5. Equities are trading at 18 times earnings. The bond cash flow, which is the coupon that you get, will terminate at the end of 10 years. Equities cash flow, which is the dividends you get, go way beyond 10-year time frame. So what's cheap? Bonds or equities? It's obvious that equities are much cheaper. And that's because bond yields are actually quite low relative to India's own history. And if they fall further, equities will actually start looking even more attractive. So no wonder households in India are piling up on shares. They're very smart. They make these intuitive calculations and realize that the best returning asset right now is stocks, and that's where you need to put your money to work. Okay, so now this is something about timing versus time. Okay, so I know everybody has the urge to time the market. Whenever I appear on television, after I give my long-term spiel on India, I invariably get, in fact, even before I start talking, people want to know what's going to happen to stocks in the next 3 months. That is still okay. Sometimes people want to know what's going to happen next week. I have no idea. I have no idea what's going to happen next week. I have no idea what's going to happen in the next 3 months. I have no idea what's going to happen in the next 5 years. Of course, I express opinion on all of these things, but really I don't know. That's the bottom line. We really don't know. Now, this is a very powerful thing for you to understand. Okay? We have computed the number of trading days since 1995. So we have had about 5,500 trading days. In that period, the index is up about 900%. Now, if you exclude, so now suppose assume that you're a very good trader and you've been trading stocks and you'll come up to me and say, no, I don't agree with you, I can really trade very well. The best 100 days have produced 600 out of these 900% returns. So for some reason, you missed those 100 days in your urge to time the market. You missed bulk of the returns that the market has produced. Even more interesting is that the worst 100 days, if you had avoided them, your returns would not have been 900%, but they would have been 1400%. Now just imagine sitting here trying to anticipate which will be the best 100 and worst 100 days which you want to avoid and own stocks only for the remaining period. It's just not possible. It's not humanly possible. If somebody in your neighborhood has done that, it's basically because he got lucky or she got lucky. It is not possible to do this, and therefore the best thing is to just sit in the market and let your returns build rather than try and time it and miss out on very large returns or accumulate very large losses. So this is my philosophy on timing versus time. In the stock market, it is better to spend time than try and time. I hope that was clear. This is just a very, rough approach, not comprehensive, but one of the things that we have learned in our years of research about picking stocks in India, the bottom line is you want to buy businesses with strong moats, with attractive returns on capital, with good governance standards and reasonable valuations. That's the way to do it. We've tried to quantify this in actual metrics, which you can actually use back home or back in your office when you're advising people for your own portfolios. So what we want is strong growth, obviously, because equities is all about growth. It can be either EPS growth or dividend growth or revenue growth. It really doesn't matter. What you need is growth. EPS is always the best, but dividend growth also works very well, and book value growth also works. The next thing is you want positive return, change in return on capital, rather than just the level. So just because a company generates 30% return on capital is not good enough. Is that going up or going down? And particularly at this point of the cycle, given that India's macro growth is turning, the delta, the change is going to be more important for stock prices. The valuation metric that works the best is EV to EBITDA because it takes care of indebtedness. Because companies with a lot of leverage on their balance sheet can look cheap on price to book and price to earnings, but they may not necessarily be so because they have a large amount of outstanding debt. So use EV to EBITDA; it works quite well. You don't want to have high financial leverage, but importantly, you want falling financial leverage. So I'm not averse to high debt as such, if it's reasonable, like say one-time debt to equity. But if it's falling, it's an additional boost to stock price performance. This is important, beta, because in bull markets, people chase beta. They want higher beta stocks, but in the long run, high beta does not do well. It's theoretically very intuitive because high beta means high hurdle rate, and high hurdle rate means you need much more growth to deliver performance. So generally speaking, a beta of less than 1.1 is what you should prefer. This is very easy to filter. You can get beta from various websites. Of course, beta can be measured in a zillion ways, and that's always a tricky thing. It's good to follow a consistent method. And so on. There are some of these other things. I won't go into those details, but this is one way of approaching stock picking. It's not comprehensive. I thought I'll just leave behind this research because we did this on several companies in India and found that it worked well in generating extra performance over the index. So I just wanted to leave behind my thoughts about the future. The first thing is that equities have been a very poor performing asset class. Exactly 10 years ago, if you bought stocks, and imagine you bought the Nifty, your return has been 0. Okay? The Nifty is up, I think, 2%, thanks to the performance of the last 2 days. Otherwise, it has been exactly 0. Instead, if you bought the 10-year bond, you made 8% every year. So this is, equity risk premium, which is basically the gap between equity returns and bond returns. So obviously equity returns minus bond returns is in negative territory because equities have not generated any return. It is also a good starting point if you look at it from a 10-year forward perspective because there's a lot of pent-up return that equities need to deliver. Obviously, exactly 10 years ago, you were in 2007 October, which was an unusually high point for valuations. And obviously, in the next 3 months, the valuations actually got higher. By Jan 08, the market was trading at 32 times earnings and at about 5.5 times book. So from that point, if you were unlucky to buy stocks at that point, then obviously in the subsequent 10 years, you really didn't deserve to make money. And that's exactly what the market has done. But I think now we have got different valuations, both relative to the market's own history as well as relative to bonds. This is how the 10-year CAGRs has fallen. So India has been somewhere between 10 and 20%, and now it has just dropped to near 0. So this is the new return paradigm for India. I do think that going forward, returns are unlikely to match the historical average of mid to high teens. The Sensex has done somewhere around 16% CAGR since the early 80s. And I don't think we will get that type of returns in the next 10, 20 years for various reasons. One being that the world is no longer in that type of a situation. Growth globally is likely to be much slower than before. And that will put a cap to India's own growth rate and therefore returns from shares. So I think you should be using more like a 12 to 13% as your benchmark rather than the 17% that we have earned in the past. The starting point of profits is very low. And that is probably going to change. We have had a big correction in profit share of GDP. Profit share of GDP had risen very sharply between 04 and 08, and then from there it has corrected. We think it is probably going to mean revert, and that means that profit growth will surprise on the upside over the next 5 years. I expect earnings, say for the Nifty, to compound at about 20%, and therefore stocks should actually do probably the same or slightly more. So that's the reason why I think that the Nifty or the Sensex could triple in the next 5 years. Because if you compound at 20%, you nearly triple your earnings. And I think stocks will do a bit better than that. Even though the starting point is a little higher than history, I think when you get into that type of earning cycle, stocks tend to actually expand in terms of multiples rather than contract. And finally, I wanted to leave behind the work that we just recently did. I think the picture is one missing, but that's okay. We think that India has done a lot of work in the last 3 years, which sets us up for very strong growth in the next 10 years. And this is essentially the work that we've done on digitizing India. There are 2 pillars to this. There is JAM, as we call it, that is Jan Dhan, Aadhaar and mobile, and there is GST. And I know right now the news on GST is all bad, but this is transient. I think as you go forward, GST will become a big boon for India. It will boost tax revenues for the government, bring down public debt to GDP. It will probably lift corporate profits as well, and also lift credit to GDP, which is very good for growth. And all of this will lead to what we call as India's digital leap. India is actually a unique experiment in world history. And I think if India is successful, a lot of other countries will mimic India's approach of digitization. So we've just put out a 125-page report on this, summarizing our conclusions that India is probably on the path of becoming a world's top 3 economy and world's top 5 market cap in the next 10 years. And that brings me to the last slide of this presentation. I've already overshot my time. Which is, you are experiencing very large inflows from domestic households. And I keep saying, picture to abhi shuru hui hai. Just wait and watch how this thing changes over the next 5 years. Households have just discovered the charm of owning equities. In the month of August, we had $4 billion of inflow into mutual funds, and people thought that maybe we hit a peak. In September, stocks fell, they were very volatile, and we got another $4 billion a month. And I think you will recurringly see such numbers because at the end of the day, household exposure to equities in India is very tiny. It's only about 5% of the balance sheet. Compare that to 15% in gold. Households own about $350 billion of equities. They own $1.7 trillion of gold. Such ratios are unseen in the rest of the world. I think there's a secular shift happening in asset allocation. India is getting younger. Younger people are less risk averse. The scars of the scandals of the 90s are behind us. There's been a lot of reform that has happened in the market. So capital markets are much better places than they were used to be. So we're seeing this secular shift, and we are projecting that domestic mutual fund assets in the next 10 years will probably cross the $1 trillion mark. So let me stop here, and we can start our Q&A.